Welcome to the deep dive. Today, we're looking at something pretty interesting. Target's Q2 2025 earnings. You probably saw the headlines. They actually beat the forecast from analysts.
Yeah, they did.
But then their stock just tanks, a big plunge. So our mission here is to unpack that contradiction. What really happened with Target's results? Why did the market react like that? And what does this big leadership change mean?
Right.
We've gone through the official earnings report, the investor call, market analysis, trying to get the real story. So let's jump right in with those numbers, the ones that seemed good at first glance. Adjusted EPS, $2.05. That was like a cent better than the $2.04 forecast.
Just barely, yeah.
And revenue, $25.21 billion.
Yeah.
Also beat expectations by over 1%.
They got numbers on the face of it.
Exactly.
Yeah.
But here's the kicker. Despite beating both, the stock just plummeted, more than 10% down in pre-market trading that day.
Yeah.
What's your immediate take on that? Why such a disconnect?
Well, look, it's fascinating because the market wasn't just looking at those headline beats, you know?
Right. That big drop, it really reflected deeper worries, concerns about the overall financial health. Specifically, you saw a 1 percentage point drop in gross margins. That's a big deal for profitability. And comparable sales were still down, 1.9% overall. Now, connect that to the bigger trend. This is actually the fourth quarter in a row where profits weakened.
Fourth. Wow.
Yeah. Following drops of 12%, 19%, 36% before this. So it paints a picture, doesn't it?
It really does.
It just highlights how tough the retail environment is. You've still got inflation impacting spending, especially on non-essentials, and then the competition. Walmart, Amazon. Amazon's pushing hard on same-day grocery now, too.
Right. That's a big threat.
So yeah, the headline numbers were okay, maybe even a slight positive surprise, but the underlying trends, they raised some serious red flags for investors.
That context is crucial. But, okay, it wasn't all doom and gloom in the report itself, was it? You mentioned some positive operational signs, maybe some hope. Definitely. I mean, while comparable sales were down 1.9%, like we said, that was actually almost 2 percentage points better than Q1.
Ah, okay. So improvement trajectory-wise.
Exactly, a positive trajectory. And they said traffic and sales trends improved meaningfully, especially in the physical stores.
And how about digital? That's been a focus for them. Is they holding up?
Digital actually showed real resilience. It grew 4.3%. And their same-day services, you know, the ones powered by Target Circle 360.
Yeah, the loyalty program integration.
Right. Those saw over 25% growth. That's pretty strong.
Okay, over 25%.
It tells you they're really leaning into those digital channels, not just for transactions, but as part of the whole, you know, customer experience, meeting people where they are.
Makes sense. And they also said all 6 big merchandise categories showed improvement from Q1. So broad-based gains, sort of.
Sort of, yeah. Improvement across the board compared to the prior quarter.
Let's dig into some specifics, though, because there were some unique wins. You mentioned this Fun 101 thing. Drove over 5% growth in hardlines.
That's right.
That's like electronics, toys.
Yeah.
Stuff that isn't clothes or food.
Yeah.
And that was their best quarter for hardlines comp sales since 2021.
Yeah, strongest since 2021. And Fun 101, it's more than just a name. It's strategic.
How so?
It reflects Target trying to lean into categories where they can stand out, you know, through trends, value, unique stuff. So this Fun 101 push, it actually included double-digit growth in their ad business, Roundel.
Their internal ad platform.
Right. And also their Target Plus Marketplace, the third-party seller platform. It's about creating a more engaging, maybe curated feel, especially for things where people are looking for a bit of fun, even if they're watching their budgets.
Leaning into the Target run feeling, maybe? Yeah. The discovery aspect?
Kind of, yeah. That experiential side. And speaking of fun, did you see the Nintendo Switch 2 numbers?
I did. Their biggest video game launch ever, they said.
Exactly. And trading cards, apparently doing really well, on track to be like $1 billion business for them this year.
$1 billion in trading cards?
Yeah.
Seriously?
Yeah, sales up almost 70% year to date. It's significant. Shows they can really tap into cultural trends.
Wow. Okay, so gaming, cards, what else?
Well, the seasonal stuff did well, too. Americana summer clothes, Mother's Day flowers, July 4th ice cream, drinks.
The usual suspects, but good execution.
Right. And they said back to school started strong. Affordable stuff like $5 backpacks, 35-cent notebooks, that resonates. Plus, teacher discounts.
And that new Champion line, the exclusive one.
Yeah.
Strong start there, too, apparently.
Yeah, over 500 items. So lots of moving parts on the product side.
Operationally, they also mentioned on-shelf availability was the best it's been in years, and inventory adjustments are done for the first half.
Which positions them better for Q3. Yeah. They said inventory was up about 2% year over year, but it was a deliberate choice for high-frequency stuff. Units were actually down slightly.
Strategic inventory management, then.
Precisely. Which kind of leads to the next big question. How confident are they, really, given all these mixed signals?
Right. What's the forward guidance look like?
Well, interestingly, they maintain their full-year guidance. They still expect a low single-digit sales decline and adjusted EPS between $7 and $9.
Maintaining guidance despite the headwinds. That signals some confidence, I guess?
It's going to signal a degree of confidence, yeah, or at least stability. But what's really telling is the investment plan. About $4 billion this year.
Okay, $4 billion on what?
New stores, remodels, supply chain, and technology. And here's a big one. Investing in over 10,000 new GenAI licenses.
10,000. Wow, that's a serious commitment.
It really is. It suggests AI isn't just, a buzzword for them. They're looking to deeply integrate it. Supply chain, customer experience, decision-making.
And does that tie into that new internal office they mentioned, the Enterprise Acceleration Office?
Directly. It's led by the incoming CEO, Michael Fiddelke, and its whole focus is speeding things up, simplifying processes, especially at HQ, using tech and data better. So the GenAI fits right in.
Makes sense. Okay, one more challenge. Tariffs. How's that playing out?
Yeah, tariffs are always complex, volatile. They said the bulk of the sort of one-time costs, like canceling orders because of tariffs, hit them in Q2.
So they took the pain already, mostly.
Seems like it. Which might mean less pressure from that specific issue going forward, maybe helping them hit that 2026 goal of being in a healthier position. Their strategy, though, is to use price increases as a last resort. Focus on value through quality and especially their own brands.
Right. The own brands give them better margins.
Exactly. Better margins, more customer loyalty. It's a buffer.
So, okay, we're dissecting all these operational details, the
Yeah.
challenges. But then, alongside the earnings, came that other huge piece of news, the CEO transition.
The big one.
The board elects Michael Fiddelke, the current COO, former CFO, to be the next CEO starting February 1st. Brian Cornell moves to executive chair.
A long-planned transition, they say.
Right. But here's the part that hit Wall Street. The stock drops again about 9% in early trading after this announcement. And apparently there was a survey back in June. Mizuho Securities polled investors. 96% wanted an external hire.
Oof. Yeah, 96% is pretty overwhelming.
So why? Why does promoting a seasoned internal leader cause such a negative reaction?
Well, this gets into that whole agent for change debate,
Okay.
Given Target struggles with sales growth and losing some market share over the years, analysts and many investors were really looking for a catalyst, someone from the outside. The thinking is an outsider brings a totally fresh perspective, isn't tied to past ways of doing things, maybe shakes things up more radically.
Less baggage, maybe?
Kind of. So seeing an internal promotion, even for someone well-regarded like Fiddelke, some just saw it as, well, potentially more of the same when they felt big changes were needed.
Okay, that perspective makes sense, even if it seems harsh. But Fiddelke does know Target inside out. What's his background again?
Oh, yeah. He's got deep roots, 20 years at Target. He's been across merchandising, finance, operations, HR, became CFO in 2019, then COO early 2024. And importantly, he's the one leading that new Enterprise Acceleration Office we just talked about, the one focused on speed and technology.
So he's an insider, but one who's already tasked with driving change internally. How did the board explain the choice?
They really emphasized the process, called it a deliberate and thoughtful succession planning process over several years, looked at internal and external options. Christine Leahy, the lead independent director, she said Fiddelke has unmatched enterprise insight and strong team trust, but also a fresh eyes mindset.
So they're trying to position him as the best of both worlds, insider knowledge, outsider perspective.
That seems to be the message, yes. They believe he can be that change agent, but from within.
Okay. So what's Fiddelke himself saying? What's his plan? He mentioned urgency. Right?
He did, stepping in with urgency to rebuild momentum and return to profitable growth. And he laid out 3 main priorities. First, reestablish merchandising authority. Basically, be unapologetically and unmistakably Target.
Meaning?
Leaning hard into style, design across everything, apparel, home, even food. Using their massive $31 billion own brand portfolio as a key differentiator. It's about that unique Target feel.
Okay, doubling down on the Tarzay factor. What's second?
Second, elevate the guest experience. Make shopping smoother, more consistent, more joyful, both in stores, he called it My Target, and online. Stock shelves, friendly staff, the basics done really well.
Got it. And third,
Third, more fully leveraged technology. Investing across the board stores, supply chain, HQ to boost speed, efficiency, enhance the experience. AI is obviously a big part of that.
how does he respond directly to that whole Wall Street wanted an outsider thing? Does he acknowledge the doubt?
He does, quite directly. He said something like, I understand this business. I've seen us at our best, and I've seen us when we're not at our best, and that informs my candid assessment today of where we have work to do.
Interesting framing.
Yeah, he's basically arguing his deep knowledge is an advantage, not a hindrance. It gives him a head start on fixing things.
Yeah.
His number one goal, he said, is to get us back to growth.
A clear mandate. But it's still a tough road, right? Especially with shopper visits down.
Absolutely. Visits fell 3.1% in Q2 overall, and even steeper, 3.9% in July alone. And it's worth noting, some analysis, like from Placer.ai, suggested that consumer backlash over how Target handled the pullback on some DEI initiatives might have also played a part in softening performance for some customers.
So it's not just the economy. There might be brand perception issues, too, for certain groups.
It adds another layer of complexity, yes. These are, as I said, persistent challenges, reflecting a fundamental shift in consumer preferences and those spending cutbacks.
So how does he plan to tackle that specifically? Any operational shifts?
Well, one thing is optimizing store roles.
Hmm.
They tested this in Chicago, having some stores focus heavily on fulfilling online orders efficiently, while others focus more on the traditional in-store browsing experience.
Tailoring the store's job based on location or demand.
Exactly. And that test went well, so they're expanding it to 30 or 40 more markets. Fiddelke's view is that retail demands flexibility, being nimble. You have to keep adapting. His core message is the business model only works with growth, taking share, and driving profit from that growth.
Pragmatic, growth-focused. Makes
Yeah.
sense. Okay, so to recap, Target's Q2 had these surprising beats on earnings and revenue, some genuinely positive signs operationally, like in digital and specific categories.
Right, the Fun 101, the gaming.
Yeah. But investor confidence just wasn't there. The stock plunged, and the choice of an internal CEO, Michael Fiddelke, clearly didn't sit well with a market that seemed hungry for an outsider.
Exactly. So Fiddelke steps in. He's got this clear vision. Reclaim Target's unique style, improve the customer experience, really push technology like AI. But he's doing it against a backdrop of, serious headwinds, inflation, shifting consumer habits, intense competition. It's a big bet on an insider's ability to transform from within.
So here's the final thought for you listening. As Target pushes forward under Fiddelke, aiming for that unapologetic Target style and growth, what does this heavy focus on reestablishing merchandising authority and that massive investment in AI tell you about where retail's headed, especially when everyone's fighting for attention in dollars and consumer behavior keeps changing? In a world where almost anything is just a click away, how do you make a brand, a store, truly stand out and feel essential? Something to think about.